Happy Wednesday, everybody. I'm recording this early since Thursday and Friday, the beginning of the Passover holiday, and I will not be in the office. The markets and offices are also closed on Friday for Good Friday. I want to share some planning ideas as we get started in Q2 of this year. Let me start with some tales from the front line, a few planning thoughts based on some of the conversations I've had with you. First, let's talk about insurance. I'm not going to go too deep into life insurance today. I'll hold that for another day. But I do want to talk about what I've spoken about before, about the insurance review. And I've found recently that this is more important than ever. Now, it may sound crazy, but some people buy their life insurance and then just leave it, term or whole life. Now, I'm not suggesting that you need to review it as often as your other investments. It really depends on your special circumstances. What I want to encourage you to do is know what you have and be sure you know who your agent is, even when that agent changes. It's also important that the company that wrote your policy knows who you are and where to reach you. This is a long way of telling you that I was recently exposed to a case where the policy lapsed and it should not have. Details in this part are not important, but the policyholder never intended for it to lapse. This can happen with lost mail, changes in payment methods, dropped scheduled payments. You get the picture. When this happens, you want to be sure that the agent will let you know. I have it on pretty good authority that in addition to sending you notices, the agent who sold it will also get notices. This is why it's so important to know who that is. I also recently found a contract owned by a client purchased 20 plus years ago, and the agent is now on the West Coast and the policyholder has never heard of him. Do they know how to reach the policyholder? What if there's a beneficiary problem? Some other issues that need to be addressed. Simply, this is one that you just need to be careful of, one that the solution is to review your insurance regularly. Myself or any of my insurance partners can assist you in this. We'll work not only to evaluate what you have and what you may need, but also help you confirm that your information is updated, beneficiary and contact information. This may be more important now than ever, so let's see what we can do on that. As we quickly approach April 18, not the 15th this year, as I've explained, I want to remind you again, please contact us as soon as possible if you want to confirm that you have maximized your IRA or Roth IRA contribution. Now, this, like most of what I say, is not blanket advice for everyone. I've told you what I think about radio and TV investment advice. In case you missed my comments on that, feel free to call me about it. But maximizing your retirement plans is not always the best choice. This is true in a few circumstances and mainly for unrestricted cash purposes. If you happen to find yourself in a position of uncertainty, whether it's a new job, a lost job, family job, or health issues, just to name a few, accessible cash is going to rule the day. This is not just uninvested money, it's unrestricted money, especially if you're under 59 and a half and you need to get to that money. You don't want to raid your retirement accounts if you can avoid it. It is possible that a 401k or 403b plans may offer access in the form of loans, but that's not advisable if you can avoid it. In most cases, you will not pay a penalty for that withdrawal, but your penalty will be often be measured in time outside of market exposure. If any of these things are part of your current position, you should make sure your cash position is sufficient before maximizing your IRA contributions. Please, let's talk about that if you want to evaluate that further. Okay, finally, to wrap up today, I want to debunk some common myths. We'll do more in coming weeks, but here's a start. First, in no particular order, giving up that daily coffee purchase is a game changer. Myth busted. While every dollar does count, it is more likely that if you spend some time in the bigger ticket items like transportation and housing, that will make more of a difference. Don't get me wrong, the math is real. That $5 latte you're getting does add up, but only about $100, $200 per month. It's important, but there are probably bigger fish to fry. Second, buying a new car. Myth number 2, auto dealers will give you the best rate on the car loan. While this may be true at some times, it makes sense to search out and research rates at your local banks and credit unions. It will also probably put you in a better bargaining position if you have the loan locked in before you arrive on the lot. Number 3, and the last for today, myth number 3, you must pay for frequent credit reports. This used to be true, but is no longer the case. The Fair Credit Reporting Act gives everyone the access to one free credit report every 12 months. There are also many websites that give you access without charging you. This is not an added expense that you should take on. Okay, finally, let's talk about estate planning. Since that often comes around tax time as well, we'll address this again in National Make-A-Will Month. Before I get into that, remember, this is general information to get us thinking. I do not give personal tax advice or estate planning advice. I'll work with you and your tax and your legal teams for this. But for now, 5 quick things to know and remember when you're setting up wills and other estate plans. First, a will may not cover everything. We've spoken about this many times. Beneficiaries of IRAs, 401ks, and insurance, those are not governed by wills. Next, pick your executor carefully and be sure to update it when necessary. This is key. We talk about beneficiaries all the time, but executors are also important too. Third, some assets do get a stepped up basis for tax purposes. This is very important for capital gains, and this is important when you consider gifting stocks during your lifetime. When you gift stocks to one of your heirs during your lifetime, the cost basis goes with it. So if you have that IBM stock that you've had for 50 years, the cost basis is probably pretty low. And if you gift that low basis and the potential tax liability that comes along with it goes to your heirs. Remember, there are many ways to deal with this, so let's talk about it with your tax advisor. Next, you may or may not need a trust. This is a common one and one that needs more time than we have. Just note that not all situations need a trust, and sometimes you should have one. This one's tricky, so estate planning attorneys are important here. Finally, revisit. If this is not obvious by now, when things change, marriage, divorce, kids, death, birth, things like this, you need to look at the beneficiaries and the estate plan also. Things do change, and the last thing you want to deal with is your estate headed to the wrong heirs. Okay, that's good for today. Have a great rest of the week and a great weekend. I'll be back Monday with a new Monday market update, so please check that out. Please feel free to share this with others who you think may be interested. Have a great rest of your week.